Hello, I'm Brian Resnick. I'm a senior investment strategist with AllianceBernstein, and welcome to Uncommon Capital, a podcast where we explore the far corners of the private markets and learn important lessons from professional investors. Today on Uncommon Capital, I'm thrilled to be joined by Jay Ramakrishnan, Senior Managing Director at AB Private Credit Investors, where she leads origination and is a founding member of the business that oversees nearly $20 billion in private credit strategies. Jay has had a front row seat to the rise of private credit throughout her career. Before joining AB, she was an executive director at Goldman Sachs and a managing director at Barclays Private Credit Partners. She holds a BA in economics from the University of Cambridge and an MBA from the Wharton School. Jay, thank you so much for joining me today. I always like to start with a little bit about the guests, and you have a really interesting background. So tell us a little bit about where you grew up and what made you so interested in the world of business and investing.
So I was born in South India. I grew up there for 9 years and then moved to the UK, to London with my family when I was 9 years old, and pretty much grew up in the UK throughout high school, undergraduate, college education, first job. And then post that came to the US to go to business school here at Wharton, and then, entered the career in business.
And so were you always interested in business and finance? Was this something early on, or what kind of led you to this?
Yeah, it's interesting. I think, my undergraduate degree was in economics, so always had a bit of a micro and a macro interest and orientation. My first job, though, was in strategy consulting for Bain. And that was a great introduction to just how companies work, unit economics analysis, how do they make money at a fundamental level.
And so it's interesting because you've really been involved with the private markets and private credit since the early days when it was just a niche market. Was it intentional? Was it something that drew you to private markets?
In terms of how I got there, I'd like to tell you that I had a grand plan. And as life is, it certainly was no grand plan. I sort of stumbled on it, but had an intuition that I would like it. So the way it happened for me was post-business school, I actually went to do investment banking. And so I did a combination of restructuring advisory coupled with capital raising across broad markets, Europe, emerging markets, and restructuring advisory. And then I was at Goldman in London at the time. And at that time, the telecom meltdown started to happen. And they asked me to actually move to the fixed income desk. And what I was doing on the fixed income desk when we first went there was putting out fires. And then the sort of related part of that job, once that was sort of done and cleaned, was to identify relative value trades for the trading desk. So they were trading loans, bonds, etc. And what I realized doing that was it was really fundamental, stripping a company apart, figuring out where value lay, and understanding credit. And I liked calling a spade a spade. I liked making a call and either being right or wrong about that call. And so that made me realize I actually enjoyed the investing side. I'd learned a lot in banking, very appreciative of that experience, but I was more fulfilled on the investing side than the banking side. So once I realized that, I stayed with it, moved back to the US, and was very clear that I wanted to stay on that side of the house, so to speak.
So private credit's a broad term, but most of private credit, really the bulk of the assets sit within direct lending, which is really your forte and the space that you've been involved in. And so I think, just to set the table for those that might be less familiar, I was hoping you could just define the space. What does it mean to be a direct corporate lender in the private credit space?
So direct lending effectively means lending that's not being done by a bank in its most simplest terms, right? But private credit, when you define private credit, it began in core middle market direct lending in the United States, right? That's the origins of private credit. And it's actually in that US core middle market where you see a long track record of data and experience, just because that's been the most established market. But today, private credit is not only core middle market direct lending, but much, much broader and bigger market than where it started. So today it includes core middle market direct corporate lending, but also upper middle market, large cap, private investment grade. It includes sourcing from the private equity community as well as a non-sponsor or direct corporate community. It includes, if you continue to extend, venture lending.
So how tied to the private equity world would you say is direct lending, generally speaking?
Yeah, it's pretty materially tied. If you look at the origins of core middle market direct lending, and just maybe just a little bit of history here for people that may be less familiar. Yeah. The core middle market private direct lending market has been developing since the mid to late 90s. Took off steam materially post the GFC. It developed by disintermediating the regional commercial banks. And so because of regulations, because of bank constraints on regulatory capital, private lenders came in to fill that void. They were constrained in capital lending. At the same time, at that time, you had significant growth in the number of middle market private equity sponsors. And so private lending to finance their acquisitions, their growth needs, as well as private equity, the growth of both went hand in hand. They both fueled each other in that 2000 plus period. And so it's still quite maturity dependent on private equity. It has morphed into some other areas, but to give you a sense, the other innovation that happened in the market was a product called the unitranche product. So if you think about financial innovation, regulation consolidation impacting the commercial banks, and then just the growth of private equity and private credit hand in hand, all those three things fuel the growth of the private credit industry.
Well, that leads me to my next question, which is, as someone who's been involved in origination since the very early days of this market, how has originating new deals changed over time, or from your perspective, how has it changed?
I think in terms of having direct relationships with private equity sponsors, trusted, established, credible, where you've transacted with them, those things are actually still the same. Those same needs exist today and they existed then. I think the difference is, one, there are more lenders, right? So private equity companies do have more people to choose from. That being said, I think the difference then versus now would be at a given private equity institution, you may have needed multiple relationships by different sectors that they focus on in order to source a deal. Today, most private equity firms, I wouldn't say most, but a lot of them, is the right way to say it, have debt capital markets professionals that come from leveraged finance backgrounds on the street. So you're calling on the debt capital markets professional whose job it is to raise capital from private lenders like us. So who you're sourcing from at a private equity firm may have changed, right, with that setup. The second thing I would say is I think it's over time increasingly important to have what I consider value-added sourcing, right? So having sector depth, being able to move quickly and competitively on terms, being able to give a view because you have sector expertise has become a lot more of a requirement today, and ways in which you can differentiate on the sourcing side. So being value added beyond just capital and having those relationships where you're at least top of that list in that small group that they initially reach out to get competitive terms. Because they've transacted with you, because they know that you know the space extremely well, because you can speak for a certain size of capital and continue to grow with these businesses over time, and you're not just capped out on the first entry. Those things are crucially important. So the dynamics may have changed in terms of just the number of parties, but when push comes to shove, a sponsor is not calling 20 lenders to club up a core middle market deal, right? They're going to their 4 or 5 they need to go to.
I think with so much capital flowing into the space, there's concerns about overcrowding have emerged. More recently, some senior executives have criticized the markets as lacking discipline. What's your perspective on these concerns that are out there in the headlines?
Yeah. I mean, there's clearly been a lot of headlines. I think there have been some of the names we've all read about. And whenever a space has grown fast and there's AUM growth and there's capital raising, people get concerned, right? There's a little fear when things move a bit too fast, right? If there's something missing. That being said, I think the way I see it is I don't think there's any sort of systemic undiscipline in the market or lack of discipline in the markets, right? I don't think there's any systemic. I think it's very manager specific. There may be managers that are more disciplined and others that are less disciplined. So I think it's very manager specific, so it's very hard to generalize. So I do think the issues that have come to the fore more recently, some of those earlier ones were not direct lending related. They were more securitized or broadly syndicated. Others tend to have specific, unique things that are relevant to those companies and those investments rather than, what I see as a lack of general discipline across the entire marketplace. What you do sometimes here, and again, I don't want to generalize here, is if you are a newer entrant and if you are a sort of market share player where your objective is to gather assets, right, primarily, versus, and secondarily, invest for good risk-adjusted return, then there is potentially an incentive for you to do some things which could be classified as weak underwriting, right? I'm not saying they do that,
Sure.
But I'm saying that potential exists for that. But I think if you do look at, players that have been in the industry for very long periods of time, I read some statistic that more than 70% of direct lending managers or private credit managers have been in business less than 10 years, right? So there are a few people that have been in since the mid-2000s, early 2000s, and been through the GFC, been cycle tested to that. So I do think that for those types of players, you see pretty consistent returns and an ability to remain disciplined on underwriting.
It sounds like what you're saying is fundamentals are still pretty strong in the private credit markets, but with all this new capital and incentives for managers, there may be some discipline idiosyncratic-wise in some managers, but overall in the market, you're not seeing a breakdown of discipline or fundamentals, and it sounds like a pretty compelling space. Would you agree with that?
I would agree with that. I would also say, look, I think there's been a flat. Why has it grown, right? If you look at the attributes of it, private equity sponsors have enjoyed using the benefits of private lending to finance their acquisitions and grow their businesses. It's pretty certain capital. You can, with no flex terms, et cetera, efficient execution. Not to say they won't use larger markets, but for those credits where they've valued the financing tool, separately the financing itself, the asset itself is returned. It's given the return to investors with steady cash distributions, premium returns to what's available in the broadly syndicated and the high yield markets for the illiquidity, validly, right? And with manageable actual experience loss rates. So that has a flywheel effect where LPs have been funding that space as well. And that's why you saw the massive growth.
So in a way, the private markets have become such a large component of the capital markets that not investing, or at least considering investing, is ignoring a large part of the underlying economy.
Yes, no, I would agree with that. I mean, look, it ultimately is going to depend on the investor's perspective as to what they need in terms of risk return, liquidity, trade-offs, et cetera. But what I would say is that core corporate direct lending, it's a very classic fundamental need, whether it's done by banks or private credit, et cetera, it's being done by banks. It's being satisfied by the direct lenders in a meaningful way, right? Over 80% of all direct lending now to corporates is done by non-bank lenders, right? So if you look at then from an investor's perspective, it does offer a premium yield. That premium can vary at different points in time, but if you look over long periods of time, tightest probably in the 100 range, widest in the 250 range, right? But somewhere in that zone, you're getting premium. Validly, you're getting a premium because these are illiquid. So any investor needs to understand that. You do get a consistent cash distribution income off of the portfolio because these are current income products. And it's all about manager selection. So once you choose the right, there are different ways to play, right? It could be lower, core, upper, investment grade, increasingly just because of the options available today. So I do think it's very much an attractive risk-adjusted return for most of these loans, which are senior secured and fully collateralized at the top of the cap structure. So if you think about the risk-return trade-off in the context of where you are in the cap structure, and you look at performance over periods of time, as long as you choose the right manager that you're comfortable with, I do think it's an interesting holding.
Now, what kind of opportunities are you finding in the market today?
So the opportunities in the market today will be driven by a combination of things. M&A activity. We do think that, we don't know, obviously, with some of the noise going on, but we do think that M&A is poised to pick up, right? LPs do need a return of capital. Private equity sponsors will look to be selling good assets, and there's continued need to finance those. So, in terms of opportunities, that core mainstream opportunity continues to remain and be there. what do we like? I mean, we tend to like businesses that have attributes we look for, right? That may lead themselves to certain sectors, but we look for attributes fundamentally. So we look for attributes that meet our sectors, which may be generally related to areas like repeatable revenue streams, visible revenue streams, recurring revenues, some secular growth is helpful. Very strong competitive positions, durable value through all cycles that have been shown to hold value. Flexible cost structures. So if there's a softness in the market, you can flex your cost base down. And businesses that not only hold value, but if we get the bet wrong, we know that there is a way to restructure around them, and we know what that playbook looks like, right? Now, sectors like digital infrastructure, business services with a core base staple kind of need, select segments of healthcare, and also, select areas and types of software. Like all of those areas we've played in. So I don't think we wouldn't play in any of those, just given we know those sectors deeply, as one example. So I find good, interesting opportunities across all those sectors.
Not unrelated to that, there's a lot of talk about AI. It's impossible to talk about markets of any sort without talking about artificial intelligence. To what degree is that impacting how you're going about investing?
So two things. It's a big question, right? You can analyze it on multiple dimensions. The first thing I would say is everyone is adopting their own journeys in AI as a business themselves, right? So we ourselves are constantly playing with it, figuring out our best use cases, making ourselves as a private credit manager more efficient, faster, smarter, quicker, all sorts of stuff, right? So that's one aspect of it. The other aspect is any new investment that is coming through our platform today, AI is extremely topical. We address it in every investment committee. We have an AI lens. In fact, our team internally, our software team has done an AI sort of white paper. We have a grading of where we believe the risk is greater versus lower. And so we put everything through that lens, and it's an active discussion. I'm not sure that it's existential for every software company. And I think the two things to consider are what type of software company and what is the company doing itself in terms of its product rollout and AI strategy. And, some of the more mission critical enterprise software businesses where they are able to, as incumbents, actually invest in R&D and stay ahead of the curve and develop the tooling, they are probably much better positioned to actually come out the right side of this whole equation. So I would look carefully into the type of software. What does it do? Is it a sort of tool or an app where it's a fickle near-term risk, in which case that's more at risk? Or is it truly B2B mission-critical entrenched software where it has to perform accurately at scale and there are huge switching costs to ripping that out? And what are they doing themselves to invest in that AI technology product roadmap? And I think those companies are better positioned to survive that. So you'll have to look at it deeper than just Gen AI is going to kill everything near term. There will be some runway. So we're watching it. We're all sort of seeing the impact of it as we experience it, but we are ahead of it, right, in terms of trying to stay abreast and making sure that separately in our portfolio companies, we're talking to our portfolio companies, making sure we understand what is their product strategy, what is their strategy around AI, not just in general terms, but specific terms. How are they staying ahead? And how are they adopting AI? So all of those are the ways in which we are staying around it, and also from a new investment lens, like I said, anything that comes through goes through that lens.
So do you expect the direct lending markets to continue to grow? And what do you think the future of direct lending looks like?
Yeah, so I do expect the direct lending market to continue to grow in the US, geographically in Europe, and, earlier stages, but Asia is starting to develop. So it's a global, more secular phenomenon in terms of the growth. In the US and globally, in Europe, I've seen estimates of, depending on which body of industry work you read, somewhere in the 11-12% range. That's still healthy and robust. So notwithstanding it is maturing, that's still healthy, robust growth. And I do expect that to grow because the middle market in the US alone, just as an example, is huge. It's vast. It's constantly in need of capital. These businesses are growing, and the private credit landscape and direct lending in particular is established. So I expect it to grow. I also expect it to continue to be supported by institutional investor interest as a core holding.
What's been your biggest surprise, and can you think of any, mistakes or surprises that you've seen or experienced that have really taught you some valuable lessons as it relates to direct lending in the private markets?
So maybe just on the surprise part first. At an industry level, I think what has surprised me is just how central private markets and direct lending has become to the financial ecosystem. And just the rate of financial innovation, whether it's going into different size segments or even just the ways in which tooling has developed to make the product or the asset class more accessible, right? Or you had typical institutionals started off investing in it, maybe some endowments, expanded materially, typical closed-end funds. Now you've got evergreen funds, you've got BDCs, you've got the public non-traded BDCs. It's gone from ultra high net worth to retail. So that whole democratization and the rate of financial evolution that's gone hand in hand with it has been interesting to just how it's ballooned. Nobody would have thought of being able to do these kinds of things even as recently as 5-7 years ago. I mean, on the mistakes front, I don't think there's sort of a one single mistake, right? One of the things I think we've tried to do is say, okay, well, what have we learned from that? And have that be sort of a feedback loop, if you like, is to what I think of as sort of red flags, right? So over the years, I would say things like, financial reporting systems, turnover, who owns the capital, and in some cases, was there a risk that we saw? Yes. Did we identify the risk going in? Yes. Did we have a mitigant around it? Yes. But did the risk prove to be deeper than what we anticipated? Yes. Right. And so we've lived and experienced all that over the history of investing, I would say. So what I call it more red flags that we're now allergic to versus which we may have seen through experience, which became a red flag. So I wouldn't say a mistake, but it's an observation that we then tag.
And I think that speaks to credit investing in general, right? Because at the end of the day, you know what your upside is in terms of your coupon and your carry. And the question is, can you underwrite to a certain probability of loss?
That's right.
So allocators often struggle with wide dispersion in management returns. In your view, what separates a successful manager from those who haven't performed well? And what advice would you give to an allocator when choosing a manager today?
So definitely manager dispersion has increased and will increase. And, that's a natural part of what I expect to see happen as the markets continue to evolve and private credit has more entrance into the space. From an allocator's perspective, there's sort of two sides to it. I think about it as the asset selection side as well as the business or platform design. And I think both things are crucial, especially as you look at a manager today. So on the asset selection side, everyone talks about track record, right? But what I think of as track record is, has a manager been able to show over long periods of time the ability to generate returns in the target range with low losses that have been cycle tested through long periods of time? That's really what it's about. When you peel the onion back, that's what you want to see. When people say they have a great track record, it's that to me. And has that come from an investment philosophy or a strategy that's been consistently applied? And so you have proof of concept on that strategy through long periods of time with low losses and target returns, right? So that's sort of the essence of what you're looking for from the asset side. I do think, other elements that go into that would be things like, do you have an established sourcing? And differentiated sourcing is critical. Running originations, I have a strong perspective on that, but that's key, right? To have the selectivity that you need. And equally important is a critical workout team that actually knows how to recover, because in any large portfolio, you're going to have some tail portion of the portfolio that may not go according to plan, but the skill is knowing how to recover as much of your principal, if not all, that you can. And that is a skill and a tool set that you want in the book. So that's what I would say on the asset selection side. But the reason I mention this concept of platform design or business is because increasingly I think that's an complementary and critical component in terms of assessing the manager, because you want a manager that's going to be able to have a sustainable direct lending or private credit business over long periods of time. And so how you set up the business platform is as important as the first step, which is picking good assets and avoiding losses as far as possible. And that in direct lending, these are illiquid assets. So things like portfolio construction become critical. Meaning if they are illiquid, how do you mitigate illiquidity? One way is to have diversity. And if you have a large, diverse portfolio, then a given asset, which may have some idiosyncratic risks and not go quite so, it's not going to shake the performance of the entire portfolio. So managing diversity is critical, something we focus on at a high level. And then the second part is most direct lenders today finance themselves. So they leverage their investments, so they're getting financing. Through the GFC and otherwise, there was that you saw in the industry asset liability mismatches, meaning they had long duration loan assets, but they had short duration liabilities. So when you had a market turmoil, you are in the position of being a forced seller in order to meet your financing obligations. And so having that financing structure dovetail in a way that you have matched duration between the assets and equity as you do in your financing is critical. So why is that important? Because it goes back to returns. Having stable capital and having matched your sort of asset side and your liabilities is important, because if you have stable capital, you actually can go into markets offensively. If there's a dislocation, you might actually want to take advantage to invest in really good risk-adjusted returns. You can get in those environments and be selective and pick those. But you have to have the capital base that's stable to do that. And so those are the kinds of things that I would look at when assessing a manager today. The world is more complex in terms of the private credit landscape.
So, Jay, we've talked about so many things, from the development of the industry to thinking about where things are going. And I know our listeners have learned a lot. I've learned a lot. What I would ask is that if you had one thing that a listener could take away from this conversation, what would that one thing be?
So I think the one thing I would say is to look beneath the noise, right? So notwithstanding all of the headlines around lack of discipline or overcrowding or some of the anecdotes that you hear about companies, etc., the asset class as a whole continues to perform. It's a good risk-adjusted return for some portion of the portfolio. And I would encourage people to consider direct lending as a core holding if they don't have it or if they're under-allocated. And there continues to be steady growth in the space. What is critical, though, is that choosing your manager and manager dispersion is a phenomenon. And so choosing your managers wisely and carefully in an environment in direct lending where it is a complex business to run a good private credit business. So make sure you choose the right manager and the right strategy that works for you.
Amazing. Well, Jay, this has been a great conversation. Thank you for taking the time and sitting down with us today. I know I've learned a lot. I'm sure our listeners have learned a lot. And I just want to say thank you for taking the time today.
Thank you. Welcome.
Thank you for listening to today's episode. Please rate, review, and subscribe on your favorite podcast platform. I'm Brian Resnick, and you've been listening to Uncommon Capital.